Assalamualaikum warahmatullah, guys. Welcome back to our analysis of the banking crisis in the US and Europe. We are trying to understand the asset allocation, and we can see that in the case of Silicon Valley Bank, the 170 billion deposit were allocated into cash, bonds, and loan, and we can see that the investment in loan of 105 billion is the main issue here. And as we see that the Silicon Valley Bank was not able to forecast or to predict what can happen to their bond investment in view of the Fed policy of raising interest rate in order to combat inflation. So losses incurred in the bond holding here have alarmed the market and caused panic to the depositors, and so there was huge withdrawals of deposit which the bank was not able to honor. So that is essentially the issue. But then our task here is to understand the nature of the asset allocation, because if we are looking at an Islamic bank where the bank is holding murabahah or tawarruk of 70 billion, and the bank is holding sukuk of 105 billion, and we see that this murabahah and tawarruk and the sukuk and the deposits, mudarabah deposits, tawarruk deposits are all Shariah compliant. But then when it comes to the business strategy that has gone wrong and that has caused the bank to go under, right? So this bank is shut down by the regulator, and the capital has been destroyed. And as you see that if this is an Islamic bank, who is to be blamed? Of course, we will say that, well, the Shariah advisor are not involved in the day-to-day running of the bank, and the decision of investment, risk appetite, risk oversight, risk governance are mainly, accorded to the bank directors, and therefore the losses incurred by the bank is the responsibility of the board of directors. But then again, this is an Islamic bank, and should we be departmentalizing Shariah from a commercial dimension of the decision making? Are we saying that the Shariah governance is isolated from the commercial operation of the banking business? Right, so this is something that we need to understand, that there shouldn't be any, separation between Shariah governance and corporate governance. That the mandate given to the board of directors should be, separated from the mandate given to the Shariah governance. But here we are looking at a case where a bank went under, the bank become a bankrupt company. And who is to be blamed? Who should take responsibility? Is it the Shariah committee or is it the board of directors? So something needs to be explained, and that is why I would say that the issuance of the Shariah Governance Policy Framework 2019 require the board of directors to integrate Shariah governance with the banking and business risk strategy, right? So that there shouldn't be any demarcation or siphoning or siloing Shariah governance from corporate governance. Here, it is a mandate given to the Shariah committee and the board to have a fiduciary duty, and to have an oversight function on the running of the Islamic banking business. So if we were to isolate Shariah governance from corporate governance, if we were to separate responsibility with regards to profit and loss and haram and halal, then I think that the Islamic Bank cannot go forward. So it is very important for us to look into this matter of how to ensure that there is some participation of the Sharia governance in asset allocation, and that require a lot of commitment of the Sharia committee member to understand and to consume the skill and knowledge required, to run the bank and to see that the bank is profitable and it is, away or protected from risks arising from default or arising from interest rate volatility. Okay, so we can stop here, and inshallah we can continue in the next video. Assalamualaikum warahmatullah. Thank you.